Warren Buffett has added 8.8 million more shares of Occidental Petroleum OXY stock revealed in his Q4 filings. So what does this mean for us? Does Buffett see value in Oxy when the market is already expensive? We'll review valuation metrics that you don't want to miss right here on Intrendias. Occidental is an oil company founded in 1920 that performs hydrocarbon exploration and petrochemical manufacturing. Company's oil and gas operations are mainly in the United States and the Middle East. Whoa, so Trump is in office and his stance is drill baby drill. So Oxy stock has got to go up, right?
Energy emergency. We will drill baby drill.
Well, not exactly. Drilling more will definitely decrease oil and gas prices, which is good for the consumer and transportation companies. However, oil companies don't want to maximize oil production. They want to maximize profits, and drastically increasing the supply would actually hurt profits. Remember when you blacked out on those Four Locos back in college and you missed out on that Econ 101 lecture the next morning about the difference between elastic and inelastic demand? No, right. Well, of course, because the Locos. Well, allow me to provide you with a refresher. Elastic demand means that a small price change can greatly impact the quantity demanded for said good or service, while inelastic demand means that the quantity demanded remains relatively sticky even if the price changes. Our goods here are barrels of oil. So is oil elastic or inelastic? Oil is inelastic in both supply and demand because oil is seen as a necessity. Cars, planes, and ships run on oil. Oil and kerosene also fuel heating systems. So even if the price of oil goes up, people will still need to buy it. After all, you still need to go to work, especially if you live in the US, and trade through plane and ships will continue. In our supply and demand chart, we can increase the supply of oil by pushing out the supply line to the right. We see prices drop greater compared to the increase in quantity demanded. Oil companies would have to tiptoe between production and profits. EIA.gov also seems to forecast an increased stock buildup. They expect oil prices per barrel to decline from $80 to nearly $60 by the end of 2026. Mixing this price decline with weak demand, Oxy and other oil companies could see their bottom lines decrease. Oil also experiences inelastic supply because it's costly and time-consuming to develop or acquire new sources of oil. Oxy did exactly that. They acquired CrownRock for $12 billion, which developed oil and gas in the Permian Basin, land rich with oil and natural gas in West Texas and southern New Mexico. Whoever controls the resources has the advantage. So Oxy is building a moat in the United States, which is more predictable geographically and politically compared to the Middle East. Oxy is now the fourth largest operator in the Permian Basin behind Pioneer, EOG, and Conoco. Oxy also predicts that this acquisition is expected to deliver increased free cash flow on a diluted share basis, including $1 billion in the first year based on $70 per barrel WTI. If this comes true, this additional billion in free cash flow can further favorably entice the company's stock valuation. Oxy's current price to free cash flow before Q4 2024 earnings stands at just 22, compared to Exxon at 41 and Chev at 49. Competition's stocks are twice as expensive compared to Oxy on a price to free cash flow basis. The average price to free cash flow for the integrated oil sector is 67, so Oxy is trading at 3 times discount. Free cash flow good news does not stop there. Simply Wall Street provided a levered forecasted free cash flow on Oxy based on the discount cash flow model. Check out my Python video on coding our own DCF model in the top right. The forecast suggests Oxy will reach $6 billion in free cash flow by 2032. The last time Oxy had $6 billion in free cash flow annually, the market cap was worth $52 billion. Currently, Oxy's market cap is only $44 billion. If Oxy can grow their free cash flow, then Oxy's share price could go up 36%. Now let's get bullish here. With the CrownRock acquisition, Oxy believes they will generate an additional $1 billion in free cash flow. So let's add a $1 billion to Simply Wall Street's forecast. This bumps up the potential gains to 58%. Oxy also trades at a discount on a price to earnings and EV to EBITDA basis. Price to earnings measures the current share price relative to its earnings per share, or EPS. EPS is derived using net income, and Oxy has been able to keep net income stable between $1 billion and $2 million. With the CrownRock acquisition and crude oil staying above $70 per barrel, we could see net income rise, resulting in Oxy's current price to even be more enticing. Finally, EV to EBITDA is a financial valuation metric that compares a company's enterprise value, or EV, to its earnings before interest, taxes, depreciation, and amortization, or EBITDA. It is used to evaluate a company's overall value and profitability, making it useful for comparing companies in the same industry. It allows investors to compare companies regardless of capital structure, making it useful for comparing companies with different debt levels. Plus, it excludes non-cash expenses and it provides a clearer view of operational profitability. Oxy has a EV to EBITDA of 6, while the industry average is at 8.7. This could signal that Oxy trades at a discount or the company is experiencing unique challenges. The unique challenge for Oxy may be its high debt levels and higher capital expenditures in 2024 because of the acquisition. The company has a lot of proving to do to ensure investors that this was a worthwhile investment. Because of this need for cash, Oxy significantly dropped stock repurchasing in 2024 as well. But this is a short-term pain for potential long-term benefits. Oxy's profit margins continue to stay healthy, currently at 63% and projected to go higher. So let's review the bullish factors. The $12 billion CrownRock acquisition will increase Oxy's production capacity. The company predicts an additional $1 billion in free cash flow, assuming crude oil stays above $70 a barrel. The acquisition could be seen as short-term pain because cash outflows have increased while Oxy adopts high debt. But Oxy's working towards debt reduction. Oxy raised $9.6 billion in debt to finance the acquisition, but also paid down nearly $4 billion, showing a commitment to balance sheet strength. Oxy is increasing its strength in the Permian Basin, enabling Oxy to drill in politically stable regions compared to the Middle East. Finally, Warren Buffett's Berkshire Hathaway owns a 28% stake in Oxy, providing a strong institutional backing. Plus, Buffett has continued buying Oxy shares in 2024, suggesting long-term confidence. So let's also review the bearish factors. Oxy's leveraged increase due to CrownRock deal. If oil prices drop, servicing these debts could become a challenge. The EIA forecasts crude oil to go towards $60 per barrel by 2026. If oil prices fall below $70 a barrel, cash flow and stock performance could be pressured. Finally, a global slowdown or recession could reduce oil demand, negatively impacting earnings. Check out my previous video on the top 3 recession indicators in the top right. Overall, I believe that the positives outweigh the negatives for Oxy. Oxy is setting themselves up for success with this investment and paying down debt to promote a stronger balance sheet. Buffett's backing also boosts the positives for this stock. From a free cash flow perspective, the company trades at a 3-time discount compared to the industry average. If the acquisition does generate an additional 1 billion in 2025 like predicted, the valuation would be even more compelling than it is today. Of course, Intrendias is not financial advice, and everyone has their own financial journey. Let me know what you think about Oxy stock down in the comments below, and comment what other stocks you'd like for me to review on the channel. Check out Intrendias.com for free buy and sell signals on your favorite stocks, cryptos, and Forex based on a technical algorithm in Python. And I will see you all in the next one.